Hopefully we're better here. Let me just confirm real quickly that this is firing off the way it's supposed to. Just 1 second here, guys. I need to make sure that I am up and running. Looks like we are this time. Sorry, I had the wrong stream going. Don't want that. Today, we're going to be listening to Michael Howell talk to a bunch of bears. If you guys don't know who Michael Guyat is, he does the lead lag report, Granite shares. These guys they're very bullish on commodities. They're bullish on gold. They're not so bullish on the economy or stocks. And they have been historically quite wrong about this. And it hasn't treated them very well. Hopefully the channel is firing up here. I haven't seen anybody. If you're in chat, if you could go ahead and say it. It looks like I'm up and running on X, I believe. But we'll be listening to him talk about changes in bank reserve requirements that are coming in early 2025 that will increase liquidity significantly. We're going to be listening to him talk about changes with Basel IV. We're going to be listening to him talk about just market conditions in general, answering a bunch of questions. This is the king of global liquidity, guys. This is that book, Capital Wars, that I keep referencing, where Michael Howell is just the most brilliant person you can follow. If you look for him on X, you can find him under crossborder cap. But he knows everything. He knows everything about liquidity. He is the definitive person on talking about global liquidity. They've got like 92 different metrics that they follow in order to be able to determine whether it's going up or down. It's a lot more sophisticated than people like Lynn Alden and many, many others that just look at M2 money supply. So I think this is going to be a really good conversation. Morning, George. Morning, Kamau. Looking forward to the stream. Happy Saturday. I'm going to be doing this stream today, and then I'm going to also do another one that'll be about politics a little bit later, and then I'll be working on the Discord, and if I can get that done in time and get the initial setup complete, I'll be doing a video about that as well. And then tomorrow I'm planning on still hopefully doing the Bitcoin miner one. Monday morning I will do the morning show for the market open. But after that, I'm going to be traveling again. I'm getting some repairs done. That armor plate underneath and a bunch of other things that I fucked up on my Cybertruck. So I'll be out, and I won't have a market recap on Monday. But without further ado, let's get started here and listen to these guys. And I'll just interject as I believe that a point needs to be clarified. And if you guys have questions about any of the terms being used, any of that stuff, throw it out along the way too, and I'll try and help with it. Okay. Love you guys. Let's get going.
Oh, it's Thursday, folks. Give me a second. Let me make sure everything's set up properly on
speed this part up.
All of the various social media accounts. Appreciate those that watch live streams that I host, that Will Ryan hosts. This will be a good conversation with Michael Howell, and the timing could not be better, candidly, because there's a lot to talk about as far as the Fed, the market's reaction to the Fed, liquidity in general. This is the High Conviction Podcast. My name is Michael Guyat, publisher of the Lead Lag Report, with my co-host here, Mr. Will Ryan, the founder of Granite
I'll
Shares,
slow it down in a
and of
sec.
course, special guest, Mr. Michael Howell of Crossborder Capital. Will, I don't know if you want to do a quick intro on you and on Granite Shares, and we can hand it off to Mike.
Sure, no, absolutely. So Will Ryan, founder and CEO of Granite Shares. We're an ETF issuer specializing in high conviction ETFs based in New York City. The company manages around $8 billion across a number of different ETF strategies in the US, European markets, and with distribution now into Asia.
We will definitely be hitting on Asia as well. And then Mr. Howell, I mean, everyone that thinks about liquidity, they think automatically of you. The association is unbelievably strong there. But for those who don't know who you are, Mike, introduce yourself.
Okay, thank you, gentlemen. Michael, good to see you. Will, nice to meet you. I'm Mike Howell. I'm CEO of a company called Crossborder Capital. Crossborder Capital looks at liquidity. We monitor liquidity globally. We cover about 90 financial systems, provide lots of data.
Sorry, 90.
It's very granular. We think liquidity is a key metric to understanding financial asset market movements. And that's pretty much in a nutshell what we do. We provide narrative and data, and we've been doing that pretty much for the last 30 years. My origins were that I began in the business at Salomon Brothers, the US investment bank, for those that remember it, with a global asset allocation, wearing a global asset allocation hat.
And apparently you are a legend, as some people are saying on X that are watching this live stream.
Whatever that means.
Yeah.
He is. So to be clear, he is a legend. And Salomon Brothers was no joke back in the day. And he is a very humble person, but you need to listen to what he has to say.
Exactly. So I want to share my screen because there's a post I put out, after the Fed cut, as I was in the airport yesterday, that went a little bit viral. Had something like almost 700,000 views yesterday. I said myself, I think my opinion, I think the reaction is wrong. The market initially rallied, then closed down, if you recall, on the Fed cut day. A 50 basis point move is not bullish; it's panic. Like and repost if you understand this.
I love this. First off, Michael Giad is a perma bear. He's been a bear for years. He's made nothing. When I made 600% in 2023, he sure as hell wasn't. So, and look at, I love this too because he said this went pseudo viral. He had almost 10,000 likes, probably millions of, or I'm sorry, 675,000 views. So not a million, but pretty close. But a very high like ratio. Saying that I think this reaction is wrong. A 50 basis point is not bullish. It's panic, like repost. And if you understand this, so again, he's still perma bear stance, right? But he's 100% wrong about what the direction of the market is going to be over the next year. He misquotes a bunch. This guy, I like him, but he gets it wrong a lot, and he's got a perma bear view. So you just need to think about it through that lens. Michael Howell doesn't correct all his misstatements in here. I might jump in and throw in a few. But just remember that. Remember this guy is consistently wrong. And also remember that it's exciting that a lot of people are in the court with him and believe that the markets are going to go down and that bad things are ahead. You want that. You want the majority of people to be negative on this market if you're long.
Let's start off with kind of your initial reaction to Powell, the presser. I didn't get a chance to actually watch it again. I was at the airport. But do you think they did the right move with 50?
Well, I mean, I think was it a mistake? I think the answer to that is probably yes, it was a mistake, but that mistake has got to be seen in the context of a lot of previous mistakes. So the Federal Reserve is kind of I would say, on the wrong track, or basically has been kind of behind the curve in terms of what it's been doing with interest rates. I think the issue that, we'd say is a bigger issue is looking more generally at what the Fed and the Treasury are doing in terms of what we would label active duration management. And they seem to be very conscious that US financial markets need liquidity. And they're trying to manage things so, let's say, public debt doesn't really crowd out the markets. And I think that you've got to see things in that context. The danger that you've got is they've been running on what I think with interest rates at probably too high levels. They're putting strain on regional.
So he's got the exact opposite take right out of the gate versus Michael Giad. He's saying, no, they were too tight. And they need to loosen up.
Banks, they're putting strain on the commercial property market, and they're basically sailing pretty close to the wind. Now, the rate cut probably spells that out. And I think what the rate cut ought to be seen in the context of is, number one, the change to the rules on bank stress tests that came through middle of August, which I think is a big move.
Nobody is talking about this. Changes in the stress test, change in what the banks will be able to apply towards lending in the future, and it's something that nobody is speaking of, and you need to listen to it.
I mean, this is really potentially adding a lot of liquidity to U.S. financial markets.
Okay, can you explain? Can you explain that, like the bank stress test? What exactly is
that?
Yeah,
the Fed put out an FAQ, frequently asked questions, on bank stress tests, I believe August 13th. And what they said was that they were now going to allow in the monthly stress test to bank regulators for banks to basically use the access to the discount window, access to the standing repo facility, and access to lending by Federal Home Loan Banks as part of their liquidity requirements. Now, that I think could release maybe of a magnitude of maybe 500 billion back into markets. I mean, it basically pares down the amount of reserves that the banking system needs to hold at the Fed. In other words, what they can do now is they can switch those funds into Treasury securities, Treasury collateral.
That's a
big
deal.
Use that collateral to borrow at any of those three agencies. So this could be potentially quite a significant move. So I think you've got to see it in that context. So that's number one. And that's telling us that the Fed is, conscious that liquidity is needed in the system. That's for sure. Maybe the 50 basis points is a signal. And after all, the Fed is in the game of signaling, and this is, one's got to see it in that frame. I think the other thing is that by getting rates down by this magnitude, I figure they want to devalue the dollar. One of the things that we've been arguing over the last few weeks is that maybe what the move in the yen was doing
I just wanted to say something. The change in bank reserve requirements could add like a $500 billion. I don't know if he touched on this. I was typing in chat in extra liquidity to the markets. Just that one thing that happened in August that nobody's talking about that happened a month ago. And there's a lot more.
In the early part of August, that significant jump in the yen was actually a conscious agreement between the US, China, and Japan to change the trading ranges for Asian currencies. Now, this may be getting slightly into the weeds. It may be a purely speculative or whatever comment, but the Shanghai Accord, which goes back to 2016, was an attempt to try and get Asian currencies stable against the US dollar.
Take note of this. He's talking about like an inverse Shanghai Accord happening now. I do agree with this. I was probably one of the earlier people, along with Tom Lee and a few others, when me Kevin was giving him shit, that said that the Japanese yen carry trade was a nothing burger and that there were going to be deals worked out between the Treasury, the Fed, and Japan. Michael Howell actually believes that happened with China too, and I actually am starting to believe that. But let's listen to him.
Largely by Asian economies tightening monetary policy whenever their currencies weakened against the greenback. What you're seeing now, I think, is the opposite going on, that there is a new Shanghai Accord, notionally, and let's call it that, Shanghai Accord 2, which basically is trying to get the dollar down into a lower trading range, in other words, strengthening the Asian units. But that is by the US easing policy, not by the Asians tightening. And the fact is that whatever one may say about Japan or China, these guys have got absolutely no ability at all to tighten monetary policy. I mean, it's pie in the sky to think the Japanese or the Chinese can tighten from here. China is suffering monetary deflation. They want the opposite. They want monetary inflation in them.
It's taken Michael Howell. He's brilliant, but he was wrong about the strength of China's economy. And it's taken him a while to finally get to the point to where he's like, okay, they're deflating. They're doing really bad. Maybe it wasn't as good as I thought it was going to be. He thought global liquidity would be stronger with China. He thought that their market would recover a lot better. I don't think he knew the depths of the problems that exist within their economy. So think of him as more positive on China than I am, and he's not that positive.
Their markets. And all this is really adding up, I think, to a backdrop where you've got more liquidity going into markets. You've got the dollar, which is coming off its peaks, and you've got gold, which is continuing to push higher. And I think you just look at the chart on gold over a 5-year, 1 year, 1 month basis, that is trending up from bottom left to top right. It's a clear, unambiguous, unbroken trend. And it's going higher.
Also, to be clear, guys, he doesn't reference, I think, Bitcoin and crypto in here, and he being Michael Howell. Normally, though, he will tell you in a conversation that Bitcoin and crypto will do a lot better with global liquidity increasing and actually hitting the banking sector and turning into increased money supply that's getting utilized. He'll tell you that those outperform, but this venue is a gold venue, and so he literally just glosses over that and sticks with the topic at hand because that's what these people like to talk about, and they will benefit as well, just not as much.
Is that the so let's sort of talk about gold for a second. I think that's a really good
let's talk
way
about
to
gold.
frame it because there've been a lot of questions around the gold price, and clearly a lot of people confused about how gold can get to all-time highs in a market where, or an environment where we have interest rates at these levels, and the liquidity sort of side of it is not necessarily one that I've heard as much as people trying to explain it from a demand perspective, from Indian monsoon season to Chinese retail investors. So there's an interesting sort of take on it that this is ultimately.
It's funny to me that these people are just starting to understand and listen to Michael Howell, somebody who I've been following for 5 years and getting stupid rich off of him.
A liquidity game, and the liquidity game will benefit or is benefiting gold.
Yeah, well, I mean, let me try and address that, Will. I think the first thing to say is the whole nature of financial markets has changed in the last couple of decades. They've moved away from being what textbooks understood as new capital raising mechanisms. In other words, trying to finance or provide new project finance through the capital markets, to debt refinancing mechanisms. And basically, if you go back probably 20, 30 years, every dollar that was raised by for new capital raising was matched by a dollar that was a refinancing trade, in other words, rolling over debt. What you've got now is something like every out of every $5, 4 are debt refinancing transactions. Now, the reality is with this huge pile of debt that is being accumulated by not just the US economy, by the world economy, that debt has to be refinanced. You've got $350 trillion of debt in the global system with an average maturity of 5 years, which my simple math says you've got to refinance something like 60 to $70 trillion every year. Now,
that's just an insane number. Essentially, what he's going to be talking about here is that the interest rates had to come down. We have cyclical refinance schedules. We have to lower rates in order to be able to make it towards the massive amount of debt loads don't just implode upon themselves. And so this rate cut, even though these two guys, Will and Michael, couldn't see a 50 rate cut coming, people like Michael Howell and definitely myself could see a 50 bip coming because, again, they have to lower rates. I was calling for it in July. It didn't happen then. Whatever. They were able to use other mechanisms like massive Treasury, short-dated Treasury issuance to keep liquidity flowing along while they kept rates high. And now they look like potentially, if the employment markets don't roll over, they look like they did a great job because they kept things tight and then they started to open up before employment markets started to fall apart. And that's going to help housing and auto and all this other stuff that we talk about. But we're in a debt refinancing cycle. We're not like we used to be, before the 2008 great financial crisis, where really it was like IPO markets and debts aren't that bad, and we don't have to worry about refinancing. It's really about just like growth, and all these other things. That doesn't exist anymore. We're in this cycle of just government monetary printing.
It's a huge ask for financial institutions. You need balance sheet capacity to do that, which means liquidity.
Yep.
So point number one is that if you see rising debt in the system, which clearly you are, unambiguously, the federal deficit is running at a rate of somewhere between 6 and 8%, which is telling you that's what debt is going to compound at. If that's the reality, then you've got to get liquidity to match that. Otherwise, you get financial dislocations, you get refinancing crises. And therefore, liquidity has got to keep pace. Now, rising liquidity is nothing more nor less than monetary inflation. And that monetary inflation pushes up the gold price. The gold bullion.
Just insert Bitcoin and crypto into everything that he's saying here. Again, the audience is a gold bug, so he's giving them their message.
Is the best example of a well-tried and well-established monetary hedge, which has basically existed throughout history for centuries, and it's doing it again. And the fact is, you've got more debt, you've got more monetary inflation, and you've got a rising gold price. Real interest rates, which a lot of economists cite as the main driver of the gold price, don't count. They've always been a flaky way of measuring or understanding the gold market.
These guys hate to hear this because everything they preach day in and day out, he is refuting right now.
You've just got to look at liquidity. That's the thing. Real interest rates broke down in 2022 as a driver, even a short-term driver of the gold price. There's been a huge disconnect between real interest rates and gold ever since. By all means, look at real interest rates, but you're going to miss the big story on gold, which is it's going a lot higher.
Yeah, I mean, clearly
Bitcoin.
The real interest rate argument, like you said, made no sense in the last few years after the Fed started tightening in 2022. And I think that led to a lot of people, questioning, how we can have, gold prices at these levels in a real interest rate environment like we've seen over the last few years. But I think now, like I said, the liquidity plus clearly with us entering now a easing cycle, obviously 50 basis points, maybe rather more aggressively than perhaps a lot of people thought.
I thought.
It seems like the dollar is easing or itself on a path downward.
Yeah, I mean, let me articulate this in a bit more detail because
this is great. He's going to talk, I think, more about this reverse Shanghai Accord trade. This is good stuff too. This is how China, the United States, Japan are working with currencies. It's good.
I think although it's getting into the weeds and maybe a tad wonkish, it's really important to understand the dynamics that are going on here.
We have a very smart audience, Mike, that can follow everything. Very smart audience.
I'm sure.
Just not a profitable one.
So let me step back and say the Federal Reserve did start tightening policy 2 or 3 years ago, but from October 2022, pretty much coincident with the British gilt debacle, when the British gilt market, sovereign debt market, sold off when there was an outrageous budget attempt or change in budgetary policy. The Federal Reserve, among other policymakers, began to ease liquidity. Despite the rhetoric that they were contracting their balance sheet, the liquidity creating elements on the balance sheet have expanded. They expanded even more quickly after the SVB crisis in March of 2023, and they've continued to push higher. This latest move of changing the rules on bank stress tests is effectively adding more liquidity to US money.
Again, oh no, I guess we're still focused on the banking system, liquidity. This is great stuff, though. Again, when everybody thought Silicon Valley Bank was going to be the end of the economy, I was balls deep and getting ready to make shit tons of money, and again made 600% in 2023 because of this man and other people. Knowing one of the most important things you can learn in life is how to tell the people that are real and understand what they're talking about and have the right vision of the future versus the people that sound smart, are confident, and don't know what they're talking about. This is a trait you need to learn if you're going to be a good investor, because you could follow all kinds of people that sound really smart, the doomers. The doomers have been dooming since the 2008 great financial crisis, most of them. And if you would have been on that boat for 16 years, you wouldn't have made a lot of money. So, and again, there will be times that could be darker. That's definitely a thing. Global liquidity, per Michael Howell, comes to an end in 2026. That lines up with the Bitcoin cycle. That lines up with a lot of other cyclical stuff. So there will be times where we need to readjust. And even he talks about how, even in the year plus ahead, that it will be smart to look towards later cycle type investments as opportunities. And so we'll be doing all of that. But again, listen to people who know what they're talking about. Don't listen to bullshitters. Fine tune, remove the noise, remove people that are noise and consistently wrong for years and years at a time. That are sure, like every week in their YouTube video, guys, it's really happening this time. Did you hear the thing? Ignore those fucking people. They're a waste of your energy.
Money markets. So despite the fact that interest rates have been high, which has affected adversely certain parts of the market, particularly the commercial real estate and regional bank sectors, the fact is that overall liquidity has basically moved in. And that is why the gold market is going up. That is why Bitcoin has been a great performer. That is why US tech stocks have generally done well. And that is a great background for the bulk of the market. Now, the factors I mentioned earlier on is that what the Treasury and the Fed maybe hand in hand are doing, and I think there is a lot of agreement here. Let's make the point that Janet, of course, has served in both chairs, so she knows the organizations very well, and I think they're working, I would argue, the most closely hand in hand that I've ever.
100%. He's saying that the Fed and the Treasury are working hand in hand to control what's happening monetarily with the United States world reserve currency in conjunction with the rest of the world. I 100% believe that. Is that a good thing over the long term? I don't think so. I think it just builds a bigger bubble if we don't do a good job pulling back on expenses and creating greater efficiency in government. But outside of that, for now, it helps a lot.
Already seen these two organizations. And what the Treasury is doing simultaneously is it's basically creating liquidity space in US capital markets by, number one, increasing the percentage of bill finance. In other words, Treasury bill issuance is going up significantly.
I'm just going to preface this, guys. This is such an important part of the conversation. If you have to rewind a few times to get it, if you have to look up any of these terms, do it or ask me in chat. But what he's going to talk about is that fact that shorter dated treasuries are financing the government right now. And what that does is it makes it to where they're not locked into 10-year, 20-year, 30-year bonds where the government is having to pay out high interest rates for decades. They can't afford that. That would just be catastrophic. Our interest on our debt is already at record-breaking levels. It's already more than our entire defense budget by a large margin. It's over $1.1 trillion a year in just interest. They have to lower interest rates to lower that debt, and they're issuing very short date treasuries, and he's going to talk about this in a second, to starve out the higher end of the yield curve. All that means is think 20 years, think TLT. They're making it to where there's no liquidity in that market, where the yields don't just keep skyrocketing, or I should say the yields don't get crazy and the market doesn't just implode overnight, stressing that, oh my God, people don't trust the issuance of U.S. debt anymore. This is dangerous. Maybe the United States will lose its world reserve currency status. So they're starving out the high end of the yield curve in order to be, and for two reasons. One, to make it to where we don't have these long-term debt obligations at high interest rates. And two, just so we can keep funding everything that we are right now. And then as they lower rates, all these debts are becoming cheaper and cheaper to service. So you'll see us going from record breaking interest on debts to it being a little more controlled in regard to our GDP growth if all works out, and seeing the interest start to decline. So this is going to be very positive, guys. Right now, interest rates heading into next month on houses could be as low as in the fives. And I believe by spring of next year, even late spring, early summer, when the market's really starting to open up, traditionally when real estate markets do better, we'll see commercial real estate refinancing a lot at lower rates, because I think and then we'll be in the fours on interest rates, when we were almost at 8% here this last year. It's very important to understand how quickly this stuff is moving. Very, very important. He'll talk about this more, though.
And the second thing they're doing simultaneously is they're reducing the average maturity of coupon debt in the Treasury calendar. Now, what that means is they're issuing fewer 10-year bonds, notes rather, and they're issuing a lot more in the 2-year, 5-year, 7-year spectrum. Now, why is that important? The reason that's important is they've taken about 1.2 years out of the average maturity of issuance on the US calendar. This is a big number in fixed income terms. And the question to ask is, who buys that kind of debt? We know that pension funds and insurance funds, life insurance funds, tend to buy longer dated coupons, 20-year, 30-year treasuries, okay? But it's the banks or the credit providers who tend to go towards the shorter end of the market. Now, if a bank buys a bill or a bank buys a short-dated government bond, that is monetization, because it basically means the bank's balance sheet rises pari passu with the increase in the deficit or the funding requirement. You know, Milton Friedman, who sadly is not here anymore, would be turning in his grave to look at what the Fed is doing right now. And this is the reality. They're monetizing. What
Milton Friedman, the greatest economist of all time.
is the best barometer of monetization? It's gold. Are we going to get more monetization in the future? Well, let's just look. Which among the candidates, which among the parties, Democrats, Republicans, Harris, Trump, are talking about reining in the deficit? None of them. Okay, it's not even on the agenda. Okay, that deficit, according to the Congressional Budget Office, which is bipartisan and very transparent, is going to run on at a 6 to 8% of GDP in the foreseeable future. That has got to be funded. It's not going to be funded by higher taxes. It's not going to be funded through lower spending outlays. Defense spending is going to increase. Mandatory spending on Medicare and Social Security is on an exponential rise. So that's not going to come back. So the reality is that politicians have got to kick the can down the road. And what that means is struggling to fund and increasingly using the short end of the market where they know there's appetite to basically fund. And the reason there's appetite is that if the government writes a check and you put it into your bank account, in other words, if they pay you for some service and you put it in your bank account, the bank has to find a commensurate asset to match that with. And therefore they pile into short-dated bonds and bills. Their balance sheet rises, as I say, pari passu with the deficit, and that is monetization. If they sell debt to an institution like a life insurance fund or a pension fund, that is not monetization. That is pure funding out of existing savings.
These are important terms too. He's basically talking about what counts as global liquidity. Again, they look at over 90 different metrics for this, but he's also trying to explain in layman's terms. I mean, not layman's terms. This is Michael Howell, but he's trying to explain what actually counts as global liquidity.
This is a big difference, and it's going on right before our eyes, and it's going to continue.
Yep.
So you don't think that the so-called bond vigilantes can do it?
These guys, yeah, he's going to talk bond vigilantes, guys. If I don't want to explain the whole term, but bond vigilantes are people in the private market that hold large amounts of bonds, people or entities, like let's say corporations, banks, whatever. that hold large amounts of bonds that could potentially influence the policy of government by unloading those bonds. Okay. So that's what a bond vigilante is. But he's going to basically refute and say bond vigilantes don't have any power right now. And here's why.
Anything about that part of the curve?
Well, I think the thing is that they can, and we've got to watch the bond vigilantes because they had a big effect in the case of the British.
I mean, he says can, but he's going to refute it here in a second.
Gilt market, as we know. But the fact is that if you go down the route of issuing a lot of your debt at the short end and you starve the bond vigilantes, who are really at the opposite end of the curve of coupons, what you're going to get is a scarcity of long-dated debt, and therefore yields stay down. Now, one of the things that I would argue, and other commentators, George Robertson is one on Twitter who has made a very similar point, is if you look at the agency mortgage market in the US, which is government-sponsored, government-backed, it's treated by central banks around the world as an equivalent safe asset to US Treasuries. Even the Federal Reserve has agency mortgages on its balance sheet. The yield spread between Treasuries and agency bonds, once you make the adjustment for convexity and duration differences.
I know this is a bunch of really complicated words, guys, but just keep listening. If you have questions along the way, ask. You won't be the dumbest person in the room. There are so many people that don't understand what he's saying, and I'll try and help with it too. I'll summarize again in a little bit more.
Is trading at an abnormally wide spread, which is unjustifiable. Okay, and the reason that's going on is that they're creating this scarcity. And we would argue that these various manipulations that are going on in the Treasury market are taking about 100 basis points at least out of 10-year note yields. Now, that's a big, big change.
It's a huge deal.
And the other thing to say is that, of course,
that basically means 1% less yield out of your 10-year notes, right?
Of course, if you then say, well, okay, let's just work the maths back, because what's the break-even inflation rate if the nominal bond is not yielding the actual yield now, but it's 100 basis points or so higher? It means that break-even inflation is no longer 2%, it's nearer 3.25%. And
so I've said this for a long time, guys, and this is one of the main reasons why, is that what he's saying is that basically since they're rigging the longer end of the bond markets and the treasury markets, and there's this disparity of at least 100 bips between them, that really the break-even inflation rate has changed. It's not the 2% mark that Powell even still talks about today. It's actually closer to between 3 and 4%, which I believe is what we'll see in the future. I don't think there's much way that we get around that. So again, the rate of inflation that the government is willing to accept has to go higher. Why does it have to go higher? Because our debt is completely unsustainable. And until we get our house in order, which is going to take years, and I think it can happen under Trump, especially with Elon Musk at the helm and people like Vivek, I think this is actually fixable. Unlike some people, I actually believe we can fix this. But we're going to see higher inflation. We're just going to. Now, will it be incredibly noticeable? I mean, people don't even notice at 2%. They don't notice that the government is stealing all of their money within 30 years until they're old enough to be like, what the fuck? I should have owned a house. I should have owned assets. But they realize it too late to be able to do anything about it. At 3.5%, it's going to be a little more painful, a little more noticeable all around the world. So there's going to be more tension with governments and the people in the countries just between them because of these higher inflation rates. But I do believe that this is exactly what's going to happen. I think the 3 to 4% range is what it's going to be. He also has interesting takes on what brings the commodity market higher. I don't know that I'm totally sold on it, but we'll talk about that too.
And that is a whopping great difference. So if the real ongoing, or the true, I should say, ongoing inflation, break-even inflation rate is significantly higher than the markets are thinking, you want monetary inflation hedges en masse. You've got to start shifting portfolios towards those assets. By all means, buy tips. They look great in this environment, okay? Don't buy conventionals. Buy gold, by all means. Look at these ETFs. Buy long duration U.S. equities, quality U.S. equities. They're all going to benefit.
But there's a question from the audience from Papi Sanchez. Does that can ever become too big to be kicked? Which I feel like every year everyone asks this question.
Yep, I think that's That's a great question, and I think the answer to that is that economists very often say, well, of course, these levels of debt are unsustainable. Well, hey, let's take a look. What about Japan? Japan has got whopping great public debt to GDP. People are still going to work in the morning. They're still waking up. They're still feeding themselves. There's not really.
Hey, real quick before we get on this, and I might just back up just a hair. So he was talking about tips. A tip, and I wanted to get the definition of it up so I don't bastardize it. A tip is a Treasury inflated protected security. The purpose of a tip is designed to hedge against inflation. Their principal value will adjust with the rate of inflation as measured by the Consumer Price Index, CPI. So what he's saying is a hedge, you might want to invest in tips if you think that inflation could reignite in the future in order to be able to hedge against that. So there's more to it, but that's really the gist of it.
I feel like every year everyone asks this question.
Yep.
And now they're talking about kicking the can down the road. How far can we go? This is going to be insightful.
I think that's a great question, and I think the answer to that is that economists very often say, well, of course, these levels of debt are unsustainable. Well, hey, let's take a look. What about Japan? Japan has got whopping great public debt to GDP. People are still going to work in the morning. They're still waking up. They're still feeding themselves.
Yeah, there's a reason they use the term lost decades with Japan, but they're still all right.
There's not really a problem. The economy is not breaking down. Britain in the 1950s had exactly the same situation. Britain had a huge public debt to GDP load after World War II. That pretty much bankrupted the country, but the government could still fund itself. It did. But the question is, governments always fund themselves, but on what terms? What are they doing to get that? And they're going to screw the private sectors, make no question about that. And what they're doing is they either mean higher yields or they mean monetization, as I've argued. So the can will be kicked down the road. Yeah, the can will get bigger, but the government's is wearing a big pair of boots, and they can do this, and they will. But the other thing to say, the economic performance of the British economy in the 1950s and the Japanese economy in the 2000s has not been something to write home about for sure.
And further to your point about the current sort of political parties for this election, and we've seen time and time again, nobody will address this until something breaks, and that is the bottom line. So the can will be.
Sorry, real quick. Does Michael Howell have a book? Yes, it is. Shit, I don't have it over here. Yes, it is called Capital Wars. Capital Wars. I don't know. I'll find it. Give me a second. I got it.
Kick down the road until something breaks, and then when something breaks, whoever is in power at that time will be tasked with trying to fix it. But nobody will be proactive about it. We've seen that, all from this country to all around the world. Nobody's got the political stomach or the will to deal with it.
Correct. So buy gold.
And every time he says gold, just insert Bitcoin, because that's what he actually thinks the better investment is. Even though he has an allocation in both, he thinks that that's going to yield much greater returns because he's smart enough to realize that. But he knows this audience hates Bitcoin, or at least Michael Gayad doesn't have a lot of. I don't think he has a lot of positives to say about it. I think I blocked him a long time ago just because I got tired of hearing all of his depressing shit. So maybe he does. I don't know. But this is a gold audience, and insert Bitcoin there. Now, Capital Wars, guys, back to the book story. This is several years old. It's probably one of the best books you could read. I don't plug it very much. This is Michael Howell's book. I don't plug it very much because I find that bond and treasury markets and global economic synchronization of currencies isn't a topic that a lot of people get interested in. But if you want to learn more about it, this is a great one. And if you watch a bunch of Michael Howell book or videos in conjunction with listening to an audiobook or reading the book itself, you're gonna learn a lot.
Buy gold ETF. Sorry,
but hold on. But
And like everything, I want to say, guys, you're going to be stupid when you're learning something new. It's impossible not to be stupid. It's impossible not to be ignorant. It's impossible not to understand the terms that these guys use when they throw out acronyms all the time, like tips. You're not going to fucking know this stuff. But you just listen to it and you look the things up. Use Grok. And you'll learn the terms, and then each thing you listen to, you'll learn more and more and more. And then before you know it, you'll be like, fuck, am I like a pseudo expert on this? Do I actually know this topic better than 99.9% of humanity? And you'll find that you can do that. But you don't learn new things unless you give yourself the ability to be ignorant and stupid. Being ignorant and stupid and still pushing forward and learning is how you grow as a human being in life. So you need to be uncomfortable if you're going to learn.
Go ahead. Yeah, go ahead.
Well, no, I was just going to say that another question, Michael, was about the dollar. And I think, again, probably a lot of that has been inferred from the conversation, but maybe talk about the trajectory of the dollar and the outlook for that.
Well, I think the dollar is clearly the preeminent international currency. A lot of people have been calling for the end of the dollar for a long, long time. That's not going to happen.
Nope.
The way that we view it is the dollar is probably the cleanest shirt in the laundry. Other countries.
And I didn't get that term just from him. There's other people. The guy that did the dollar milkshake theory too talks about it all the time. But it's 100% true. We are the cleanest shirt in the dirty laundry.
Have got bigger problems. Just look across the pond to France and Germany, or look further afield to to Japan, I should say, or China.
Yep.
And you've got debt problems really around the world.
Yeah.
And the US clearly has them, and the US has fessed up to them through the CBO, the Congressional Budget Office. But nonetheless, the dollar is preeminent, and providing the US remains a reserve currency, which it does, which it will do because it's going to force itself onto the world as the reserve currency. The US can basically fund itself, providing they maintain the dollar or treasuries as safe assets, which I think is pretty certain.
Well, and provided they maintain military bases. I mean,
I think all these things are important, but I mean, they're going to introduce a Basel IV next year, and that will actually increase the demand for treasuries. The stress test, the change in the stress test rules that.
Did you hear that? Basel IV, when it's introduced, and I won't go into all the details about what it is, will increase the demand for treasuries in the United States. So even if the market is doing well, when we see that get implemented, we'll start to see some people hedging into treasuries, U.S. treasuries, long-dated treasuries. So that'll be a good signal and something that we're listening out for. Basel is spelled B-A-S-E-L, but Basel IV will be one of those signs where when that's starting to come, you'll probably start to see TLT and things like that doing better and better and better. And honestly, I'll probably want money in TMF by the time that happens.
I cited earlier are increasing the demand for treasuries. So all these things are going on to broadly speaking, increased demand for US assets.
Yep.
And I think that, notwithstanding the fact that I've even said that the dollar may well dip near term, but I think that's a deliberate move to give China and Japan a window for easing policy. Yep. And that will sort of help the rest of the world, if you like, pull out of this slow growth environment, or at least try to. I still think that the dollar is a firm currency against other paper units over the medium term, but it will still weaken, and I think considerably, against gold. Now, the way to envision this, without sounding fanciful, but if you've got essentially liquidity, which is growing at something like 6 to 8% per annum, okay, which is what we've said is really baked into the cake anyway because of the size of the US public deficit. That means, simple maths. If something grows at, the law of 7.2 or the law of 72, if something grows at 7.2% per annum, it doubles every 10 years. So what you've got is effectively the stock of debt, if it's growing at that pace, doubling in 10 years' time. The pool of liquidity has got to double in that time, and the gold price is going to double in that time. These things just compound at similar rates.
Another good question off of X, which is a valid question here, which is, why are bond vigilantes even relevant when the Fed can buy all the bonds issued by Treasury?
They're not.
Well, I think that's, again, a very valid question. They're not, because, the question is, are the bond vigilantes active in Japan? No, because the Bank of Japan owns most of the outstanding debt in Japan. So they're playing a much smaller role. Bond vigilantes come from the private sector, and the private sector, if it's in the driving seat, can basically choose whether to fund or not. But if you've got alternative means of funding, such as the Federal Reserve, such as forcing banks to take up debt, then it becomes much easier. Absolutely, bond vigilantes become less relevant. They also become less relevant if you're starving them of necessary coupons, which is what is also going on right now.
These guys hate hearing this. They hate hearing this because he's educating them on why they've been wrong for years on their thesis and maybe a decade. I don't even know. So they're loving that they're hearing this and that they're starting to understand this better, but they're also hating it because it just shows how their ignorance has painted them into a corner over a long period of time.
Let's keep the questions coming from those that are watching the live stream here. From Neo, does Michael have a near-term outlook on Fed liquidity as we move into Q4?
Yeah, I mean, let me address that for a moment. I mean, Fed liquidity is a concept that when I was at Salomon Brothers, we looked at pretty closely. This is looking at for those that don't know it, it's really looking at the composition of the balance sheet of the Fed. I wrote up, I mean, the way that we calculate Fed liquidity in a book called Capital Wars about 5-6 years ago.
My boy,
and I think
plugging his book.
use that definition. Fed liquidity is likely to increase. It's likely to increase, I would envision, mainly because what you've got over the course of, or from now through the election to the year end, is a rundown of the Treasury General Account. Now, this is, again, a wonkish or arcane concept. And the Treasury General Account.
Hey guys, real quickly here too. I don't do this very often because this man works hard on his work, but I will talk in a little bit here. This is the Substack for Michael Howell. I will talk to a couple of key points about global liquidity and show you the cycle in case you don't understand it, maybe the heat map, a few other things that we'll go over near the end here after we're done listening to Michael spread his wisdom.
Account is an account that the US Treasury holds at the Fed. It is money that is outside of circulation. And if that is like a deposit account, which is just taking money, if you like, hoarding money away from the money markets, and if that's run down, it will release or re-inject funds back into circulation. And that will run down partly because seasonally outlays exceed revenues of the US, of the federal government. But the other reason is we've got the reimposition of the debt ceiling on 2nd of January 2025. And that may be a fraught exercise by itself. But the fact is that the normal rules, when they apply, suggest or say that the government has to run down the Treasury General Account ahead of that debt ceiling.
And so what he's saying is that all this short-term issuance is going to be continued to propel up until January. So we'll see an accelerant of short-term debt issuance to run down the Treasury's balance sheet. And that's good for liquidity.
To normal working levels. Now, normal working levels is a
loose term.
I don't know, a notional concept.
Yeah.
It's always really been understood to be something like, circa $200 billion. We're currently sitting at about 860 as of last night in terms of the Treasury General Account. So it could have quite a long way to go. Maybe another 500 billion down. So, that would be a significant increase in liquidity, in Fed liquidity. However, Fed liquidity is something that ultimately shows up in bank reserves. And a lot of people have.
So, yeah, $500 billion injection of Fed liquidity potentially between now and early next year from the Treasury trying to run off the general account is a pretty big deal. And now he's going to tell you, how does liquidity enter markets where it actually counts as liquidity in the system, pumping up asset prices?
I've argued that all you really need to look at in terms of liquidity is bank reserves. That's wrong. That's incorrect. And if you look at that, you'll make a big mistake. And the reason we're making a big mistake is that the level of bank reserves, as I alluded to at the beginning, are now going to be benchmarked against the stress tests that we spoke about. And those stress tests have changed, and therefore the banks need to hold less reserves. So what you're going to see therefore is excess liquidity in the US system. over the.
Yeah, because again, like he's saying, with changes in Basel IV, with bank reserve requirements becoming less over time here, recently here in August, and again next year, you're going to see excess liquidity because banks don't have to have reserves anymore. It's fucking insane. And again, with Silicon Valley Bank, you guys have to remember what happened with these bank collapses. The Fed said, "Hey guys, remember FDIC insurance? Fuck it. We're going to insure everything for every fucking bank. We'll let banks fail, but you'll always get your money." So FDIC insurance just turned into $1 billion per account. I mean, it's just fucking insane.
Course of the next 4 to 5 months, and that could be significant itself. There could be a lot of liquidity. You could be seeing, crypto, Bitcoin, gold,
Bitcoin. We said
US
it.
stocks moving up, much higher. Partly what the outcome of the election is, of course.
Maybe there's a few good questions here. So, Mr.
Did you notice that he talked about the U.S. election too? We have very different points. He doesn't get very political, but I just want to say this real quickly. I do believe, guys, that if Trump gets elected, which is my base case right now, I actually think he might gain power. It's crazy that I'm saying this, but I'll do a video later on that talks about election poll and just kind of some of the stuff that's going on with the election. There's very biased mainstream media polling that is painting a different picture that I don't think is factually accurate, and I can show you data points on why it's wrong. But if he wins, you've got basically reestablishing its previous tax cuts, which are incredibly beneficial to corporations in the United States already. If those tax cuts expire, that could get painful and weird. You don't have to worry about increases in corporate profit tax. You don't have to worry about unrealized taxes. You probably don't have to worry about these things anyways because Kamala is not going to win the Senate. But you don't have the threat of those things. You don't have that narrative building up. You don't have to worry about capital gains going up to 44%. You're going to actually see the opposite of that. You're going to see he's looking to help companies write off an expense more if they come back to the United States and start doing manufacturing here. And have bigger tax breaks for redistributing back to the United States. This could be a golden era for the United States, especially if Elon Musk is the DOGE, the Department of Government Efficiency. If he's the head of that and he's able to do remotely anything close for his recommendations to what he's done with X, reducing 80% of the staff, making systems more efficient, just changing things around in government, getting rid of all the bureaucracy, all the paper pushing, all the bullshit that slows down SpaceX and all these other companies. The FDA is horrific for drugs and all this other stuff, just slowing down and allowing just a bunch of big drug manufacturers like Pfizer and others to be able to control what smaller companies are even able to do because it's such a bureaucratic bullshit system. If you get rid of a bunch of that stuff and you create incentives, like again, Trump is talking about eliminating taxes on people that are making overtime pay. The incentive there is for the poorest of us. Hourly workers are the poorest of us, okay, on average. They now will have a huge incentive to work more, increasing the productivity numbers that we see in our economic data, and at the same time pocketing huge portions of that, increasing their ability to spend. And they're the people that have been most devastated by inflation because they're at the lower end of the rung of the economic system, the bottom 30-40%. Not just that, though, our retirees that are collecting Social Security, the people that have really been struggling by the inflation, probably struggling the most out of anybody in the United States, they're going to not have taxes on their Social Security, which will make it to where they can be in a much better position than they've been. And they can basically get back some of their spending power that they've lost. There are so many good things. If he wins, I see huge jumps higher in the economy. And again, with the Bitcoin Council, the crypto council, all these things that are going to be really, really beneficial and help GDP expand while starting to reduce debt, while lowering rates and doing all the other stuff that's going to help expand global liquidity. So the way we sit a year from now, if he wins, could be very different from somebody like Kamala, who has a more communistic approach, whose father was a Marxist economist who believes in redistributing wealth. This is a fun fact, guys. There are over 550 billionaires in the United States of America. And if we stole all the money from those people, like redistributed it, like good communists, good socialists. If we redistributed all of that, we would run the government for about 8 months, and that doesn't even include what would the secondary impact of taking all that wealth away from these people, and then seeing a contraction in the stock market like that would be worse than the Great Depression. You would see bread lines very quickly. You would see just an economic catastrophe. And my point there is that the whole eat the rich, tax the rich saying is absolute bullshit. It sounds good. It makes you think that it's good, but it's not good in any way. And it's devastating to our economy. I can see people dropping off because they don't want to hear me saying these things, but it's the fucking truth, and you should listen. And if you don't, fuck you. You're not gonna make a lot of money in the future, and you're gonna make bad choices that maybe devastate our country. Anyway, I'll get back to Michael Howell, but I wanted to make sure to indicate that I believe that there's very different paths that will unfold depending upon who gets elected. Now, Bitcoin still goes up. The money printer will still go burr over a Democratic presidency. The Fed will still print. They'll do the same things they're doing now. But your spending power might be greatly reduced. Even if Bitcoin goes to a million might not mean what it did right now or what it has historically. So you want the right people to be in power. It does matter.
The guide, maybe you can ask.
Thanks,
a couple
JD.
of those. I just want to go back to something quickly because clearly we just come off the back of this maybe historic Fed decision, and certainly one of the, if not the most watched meeting for the last couple of years, where we got a 50 basis point cut. And I want to ask specifically around that. I suppose the market expectation up until very, very recently was for a 25 basis point cut. And I think if people have probably been honest, the 50 basis point was a bit of a surprise. Did something change, or what changed to sort of warrant the move from 25 basis points to 50 basis points?
Well, I mean, the first thing to say is I don't think it necessarily matters, certainly in the way that I see things. I mean, what really matters is the flow of liquidity, not whatever rate they decide to set. That's, I'm not going to say irrelevant. It's certainly important for forward guidance, and they're really trying to tell us something by switching from 25 to 50. And they want to say that the Fed is here, the Fed is not behind the curve, and as Jay Powell indicated, this is an insurance policy they're putting in to make sure that there's a safety net under the economy. And I think one of the implications of his speech was that they are concerned potentially by the JOLTS figures, the job openings, and they want to make sure that the US economy is sort of buzzing along or humming along at a decent pace. And I think that's all quite reasonable. But I think there is, the two things or two or three things to say around that are, number one, the Federal Reserve is a super tanker, and the super tanker has changed direction.
Yeah.
And that's the point. Okay. So let's just take it at that. They're changing direction. We're now on a course of monetary easing. We can debate the speed, but ultimately we're on that course of monetary easing. I would argue that they've been easing liquidity anyway for many, many months, but that may be a moot point anyway. Another thing to say is that, the great Henry Kaufman, who was my boss at Salomon Brothers, who was probably the preeminent Fed watcher over previous decades, made a comment 2 years ago when he said that a Fed that talks about transitory inflation is a Federal Reserve that does not want to tighten monetary policy. And I think those words are very sober and important words. The Fed did not want to tighten. And a Federal Reserve that cuts rates by 50 basis points is a Federal Reserve that definitively wants to ease.
Yep, that's the message, guys. That's what Papa Powell wanted to get out to us, and that's what's happening. We are in an easing cycle, and when we look at global liquidity, we'll look at a graph in a second here from Michael Howell's work. That cycle has another year and a half to play out.
So there is an ongoing bias here, and people spoke about a Greenspan put, but we've got definitely an ongoing Fed put in the markets as far as I can see. So I think all those things are important. I'd also throw in the point I think I made earlier on, that I think this may be part of an agenda to get the dollar down as well, but hey, we'll see.
So that's a good opportunity to bring in. There's a whole bunch of questions from the live streamers, which I want to get to here. This is good. Let's do this one, because given your point about liquidity for the next 4 or 5 months, does Michael see an imminent recession on the horizon? Why or why not? This narrative seems to be consensus amongst many participants, especially with the uninversion.
Especially with people like Guyad and this dude up here from Granite Shares. This has literally been their view.
Yeah. Okay. Well, let me address that head on. I mean, the fact is that the economy is slow. The world economy and the US economy is slow. It's not recessionary. I don't see any evidence of a recessionary economy. You look around, look at the Empire State Survey recently. I mean, all these sort of factors are telling you that actually there's life and decent life in the US system. Look at the Dallas Fed weekly economic indicator. Look at the nowcast data. All this.
Yeah, I have another one. I don't know if I shared it this last week. I probably actually got it last night, but it just shows all the positive economic data that's come in over the last several weeks, and it's just so not recessionary.
Stuff is saying that the economy,
even on economic data that isn't easily manipulated by the federal government, and there is some of that, right? We know employment data could very easily be manipulated.
Is robust, okay? And for that reason, you might even question, why does the Fed need to do a 50 basis point cut, which I kind of come quietly and agree. But the fact is, I don't think you're near recession. Why do economists look at the 10-2 yield curve? Well, I kind of scratched my head. I read an article several years ago in the Journal of Fixed Income, which said if you look at the 10-2 yield curve, it is a very flaky indicator of upcoming turns in the business cycle. It's not got a great track record. And here again, it's been demonstrated because the curve inverted 2 years ago, and we still haven't had a recession. So it's not a great indicator. Now,
even the person who created the indicator said they're not sure if it's going to be right.
Without necessarily going into the detail of why it doesn't work, let me just give a sort of a hint as to why. What you're looking at when you're ultimately looking at the slope of the yield curve is you're looking at the level of term premia, which are basically, for those that don't know, term premia are the extra bits that bond investors require to hold duration or interest rate risk in a bond. And term premia are really the ultimate way you value fixed income securities. Now, the slope.
Let me give you the definition of term premium just to fill it out a little bit here, because the extra bits is probably not the best definition. Term premia, or term premium, refers to the additional return an investor requires for holding a longer-term bond and or security over short-term one. So think about this. Longer-dated bonds generally should give you a higher amount of yield on the product because you're willing to hold it for a very long time, right? So traditionally, that is how it should work. So that's when you hear term premium, think of term premium and the fact that it's usually higher for longer dated issuance.
The slope of the yield curve is telling you something about the level of term premium. What it doesn't do is tell you about the distribution of term premium. And the distribution of term premia is really, really what matters. Now, to continue down this furrow a little bit longer, in the article in the Journal of Fixed Income, what I said then was that if you look at the track record of yield curves predicting recessions, the track record of yield curves generically is actually very good, but you never know which one works. So sometimes it's the 1-3 year, sometimes it's the 2-10, sometimes it's the 5-10 year, sometimes it's the 2-30 year or whatever. You can always find a yield curve that works. So what that tells you is that what's important is not the slope of the curve, it's the convexity of the curve. It's the curvature. And when I was at Salomon Brothers, I remembered that the traders, or I came across the fact that the traders were always a lot more spooked by a flat, humped yield curve shape than an inverted shape. And that was because convexity was very high. And you basically had, you had in that case, term premium very depressed at the long end. And that was really telling you that there was, it was spooked.
And that is what the bond market, that's what the Treasury has fought against. That's why they've dried up longer term issuance, not just because it makes more sense fiscally for sustaining the government when we're at 130% debt to GDP, but also you want to dry it up because you want people to be focused on the shorter term issuance. You don't want yields to get out of control at the high end. You don't want them to think that the government isn't going to be able to service its debt in the future. So that's how they've rigged this game, and these guys didn't see it coming, but Michael Howell did.
Prospects of recession was spooking investors. So, generally a humped curve is a lot worse. And at the moment, what we have is, none of those features particularly. In other words, we don't have recessionary conditions.
Yep. And we're manipulating the bond market in the Treasury market.
Another question from the audience. It's an interesting one. From George, looking ahead to second half 2025, what if we have a split house and tax cuts come off with fiscal reductions?
Yeah, look, I mean, markets work in
Good
cycles.
question.
They never go in straight lines. And one of the things that follow, for those that follow our liquidity research, one of the things that we've been arguing, for a long, long time now, is that liquidity tends to move in 5 to 6 year cycles. The last low was October of 22. The next peak is
Okay, just because we've gotten into this part, guys, I do feel like it behooves me to show this to you. Let me see real quickly. I gotta let me see if I can find Michael Howell's latest work. Global Liquidity Weekly. Okay, so I do want to show a chart that he commonly puts out there. I won't go into all this. This is so hard to read for people who don't understand all the terms and haven't listened to just lots of hours. I'd say if you've listened to 100 hours of Michael Howell, you're going to get better at this. But you can see global liquidity is just screaming higher since June-ish. We've been seeing massive ramp up in global liquidity, with a lot of that coming actually from the West, not China. I did want to show the cycle. Let me see if he shows that in here. He's got a lot of good work, guys, that I pay for, but it's not in this one. Let me see. Let me jump out. It's in one of these. It's in one of these. Let me go over here. We'll see. He usually has his global liquidity cycle. He doesn't put it out all the time because there's a lot of other interesting chart-related information, but he does have it in here. So just give me 1 second here. Liquidity says it all. Maybe here. Damn it. It's just another video. All right. I'll try and find the chart. I'll try and find the chart while we're listening.
slated to be around late 2025, and you're going to see liquidity conditions coming down for whatever reasons. Now, the reasons could be that you get some, fiscal hard landing. That's possible. The reasons could be that the real economy then spurts ahead and starts to suck liquidity out of the financial markets. It could be that inflation comes back, which I think it probably will, and the Federal Reserve decides it's going to have to tighten again. But I think that the second half of 25 is a time when I think there's a lot more risk in the markets than right now.
Interesting.
Look at these guys; they're at a
close
loss.
To home, for me personally. So is the yen carry trade over?
Essentially, yes. Yes, because we have swap lines open, we've got deals arranged, we got a reverse Shanghai Accord trade. So yes, kind of. In my opinion.
Well, I think I think the answer to that is that my view is that I've been in the markets a long time, and the yen carry trade used to be a lot bigger than it is now. That's what I'd say. Period. It's important, but you've got other dimensions going on, and I think that there is something there in terms of what that carry trade was identifying. And in my view, what you were seeing was a deliberate attempt by, let's say, the Japanese and U.S. authorities, starting in 2022, to basically crash the yen deliberately, to put a lot of pressure on the Chinese authorities. Now, that may be a completely left field view, but my view was that when the yen started to turn, in all my years in financial markets, I've never seen a major G7 currency fall with the alacrity that the yen fell at. Markets never do that to currencies, only governments do.
All right, 1 sec. And this is really good stuff that he's talking about, but I wanted to show this for people that aren't familiar with it. So this is the Global Liquidity Index, the long-term 5 to 6 year cycle. And you can see this hasn't been updated in ages, guys. So you can see how it's been a little muddier sometimes throughout history, but look at this. Look at the peak over here on where it was supposed to peak. Look at the trough over here on where it was supposed to trough. Look at how it peaked over here. And again, that's the 65-month wave. This dotted line is his projection, and then the GLI, the Global Liquidity Index, is the result, the black line. So again, peak, trough, peak, trough. Look at timing here, almost perfect. Peak very muddied in the 2015 to 18 range, but again, trough not too far off over here in 2019. Peak almost perfect in 2020. trough almost perfect in 2023, and now we're ramping again into the latter part of 2025 in this cycle. And the chance that historically, if you look at this, it is a thing of beauty. This man is very smart and knows what he's talking about.
And I think that was a deliberate attempt to get the yen lower and to put a huge amount of pressure on China, because China was at that stage operating this Shanghai Accord to try and hold the yuan up against the US dollar. And one of the reasons that the Chinese economy is in the mess it's in is partly structural, but partly cyclical. And the cyclical phenomenon that China has suffered is it's never been able to dig itself out of the COVID crisis because monetary policy has been too tight. And monetary policy has been too tight is because they've been trying to shadow a strong dollar. And that was, emphasized or amplified by the collapse in the yen, which put even more pressure on the yuan. And finally, the Chinese had to throw the towel in and let the yuan weaken. Now, what you've seen, I think, in this latest iteration, beginning last August, 6 weeks ago, what we saw then, in my view, was an agreement somehow reached. We don't know what the terms of that are. It's a Sula-Tarbel deal. It may be connected with Ukraine. It may be connected with Treasury purchase. Who knows? Between America, Japan, and China, to basically allow Asian currencies to fluctuate in different ranges. In other words, they're going to move, slightly weaker against slightly stronger against the US dollar. And to do that, the Fed had to ease, and they're talking the dollar down. So my view of the yen carry trade kind of rests on that view of what I call the Shanghai Accord 2. There's bound to be casualties out of the yen carry trade, but the bodies haven't really come to the surface truly yet. And it may be that the reason they haven't, it was never as big as maybe people thought. I don't know. We'll see. You may have a maybe you think it's bigger.
My 2 cents on it is that I was actually talking to one of the major Japanese banks yesterday about this, and the bottom line was something that you just said, Michael, a few minutes ago, and that was, when it comes to currencies, it's all a relative game, and it's about the interest rate differential. And the bottom line is, for so long as the yen or Japanese interest rates remain low, then it will still be a funding currency relative to other currencies that have a lot higher interest rates. Mm-hmm. So I think that some of the excesses have blown out of that particular trade, given that we had this extraordinary situation where with zero interest rates in Japan, but the yen was depreciating at the same time. So it was sort of manna from heaven, for anybody who was borrowing in yen and then using that as a funding currency.
I'm going to speed this
assets.
up to 1.25.
I think some of those excesses have come out as we saw in the beginning of August. But so long as it remains a cheap funding currency versus other alternatives, people will still want to use it as such, and therefore it's not over.
Yeah, I think that's well said. Yeah.
It's a good question off of YouTube from E.R. Berg. Yeah, in any of your opinions, has unemployment replaced inflation as the narrative driver?
Yes.
You mean in terms of what the Fed's doing?
Yeah, as their excuse, let's call it.
Yeah, I think that's right. I mean, as I said, I think that the J. Powell's presser sort of indicated that it was the JOLTS numbers that was kind of spooking the FOMC. I think that kind of makes sense. Yeah. I mean, the fact is they think they've beaten inflation, because at the end of the day, this sort of neo-Wickselian framework that they've been operating for the last decade or so really looks at break-even inflation rates. And if you look at break-even inflation, at the 10-year level, it's pretty much touching 2, and at the 5-year level, it's under 2. So, tick those boxes. The Fed's done what it says. The fact, the reality is that I don't think those are the true underlying inflation rates, because I think if you substitute, let's say, the agency mortgage market for the Treasury note, you get a very different break-even inflation picture, which is at least 100 basis points higher.
Yeah, but there's no doubt in my mind that they had to plant the flag and declare victory on inflation in order to.
Yeah, and he's right. Again, 100 basis points higher. We're going to be in the 3s to 4s. That's what it is now.
And now transition to the other part of the dual mandate, and now start to talk about defending the.
We're about 75% of the way through, guys.
Employment market. So you can't have it both ways. That you have to, on one hand, say the battle against inflation has been won, declare victory. Now we can move to the other part and now we focus on unemployment. And that's really the only way that you can sort of transition and make that turn to enter that new phase now, which is going to be one of easing.
Yeah.
I want to go back real quick to the China point. I would think that China needs as much of a weak currency as possible, just from an export perspective, given their economy. What can turn that super tanker around? How do we get China back to being a driver of
nothing? Nothing.
Well, I think the answer is, look, the first thing to say is you've got to divide up the cyclical from the secular, or the trend cycle from the trend in terms of looking at China. China's got a long-term trend problem, as we know, because there are structural problems. And I put it this way, that the model they've got of red capitalism, it doesn't work anymore. And that model says that they've either got to build bridges to nowhere, keep piling on the infrastructure spend, which is a big debt burden, which clearly is unsustainable in the longer term, or they've got to export their way out of it. And whereas the West was accommodating for 2 decades,
that's gone.
That huge export boom, the West is no longer accommodative. So China's got to change. How they change, I don't know. But ultimately, I think that what China requires is a very significant devaluation of its real exchange rate. Okay, so that's what's got to happen, and it's not going to happen through price deflation, because if you get price deflation of the magnitude that's required, the Chinese economy implodes, and it's the end of the CCP, or it's whatever. I don't know. It's the end of the regime, and they can't allow that. So they basically
exactly. So like if they don't control the currency, China would already collapse today. So there's definitely coordinated effort. And as long as we play ball, we've got, let's put it this way, the whole teabagging meme where there's a dog with its nuts sitting on top of another dog that Elon likes to use towards people like Gavin Newsom, where he's the one on top. Just think of the United States on top of China right now with its nuts hanging in its face. That's the reality of the world that we live in right now.
Basically got to devalue the currency in some form. Now that clearly has global implications, but it may be that there's a way out, and the way out is some deal that is made that there are openings in Western markets under certain terms. It may be that the US agrees to devalue the dollar a bit to give them a window. I don't know, but these structural problems are big. Now, in the short term, what China needs, continuing that theme, is an ability to ease monetary policy. They've been trying to do it. In July of this year, there was a big easing of monetary conditions. They pulled back a tad in August, and this month, September, has been kind of mixed too. So it's not clear they're getting a trend easing.
For the people that don't know what I'm talking about, this is the meme. I'll probably be using it a lot in the future. Right here. Okay? This is it. Teabagging. That's what we're talking about. The USA, China. USA, China. Just think about that. Okay? All right, moving on.
But if they do a trend, if they do ease significantly, which I suspect they will do, because my narrative is one that says the Fed is going to ease more, the dollar is going to come down, the gold price is going to go up, the Chinese have got a bigger window to ease, and I think they're going to use that. That if that happens, what you're going to see is commodity markets moving up quite smartly, and I'll be looking there as the first evidence. And my very, very simple rule of thumb is that the Fed rules the financial markets, and the People's Bank of China pretty much rules the commodity markets.
Okay, so the other questions here. By the way, folks, again, this is the High Conviction Podcast. Everyone, make sure you follow Michael Howell and Will Ryan, and hopefully myself, as well as the Granite Shares handle a lot of really interesting funds that actually fit very nicely with this discussion. On a side note, that Will has brought to market through Granite Shares. Let's see here.
Great questions, by the way, today. Really good questions.
I'm actually, thank you for everybody that's watching. This is great to see the interaction. Really this is a good one also from YouTube. Rami Ibrahim here. What was the reason for the 11-1 vote for 50 basis points when most were torn between 25 and 50? I don't know if there's any sort of debate there.
It may say something about Jay Powell's personality. Maybe he was strong enough to bully the rest of the FOMC. I don't know. But I think that, I think at the end of the day, look, what they, the interesting question to ask any rate setter is, when they vote for 25 basis points or 50, what do they really think they're voting for?
Yes.
What is that?
This is key. This is key.
To do? And what they're only really trying to express is the fact that this is a big easing, not a little easing. But the fact is, we know it's an easing, and I think the only thing that they're really saying here is that they want to tell the markets that they are definitely not behind the curve, and this is one of several interest rate cuts that are coming.
Yeah, that's exactly it. The 50 was just signaling. It doesn't really mean anything beyond signaling. I mean, it does. It's impactful, right? Cutting by 50 rates is huge. But it's really we're going big, guys. We're ahead of the curve. Unemployment ain't bad yet. You're going to be all right. Markets have the okay to go higher. That's what it is.
And I think it's that, Michael. I think
my
maybe
bad.
perhaps inferred in that question, and again, I could be wrong, but what's perhaps inferred in that question is that there's always that question of what do they know that we don't know? And the 50 basis points sounds panicky. What is going to happen? Or
These guys want it to mean that the markets are going to go down. They want it to mean that.
what do they know that we don't know? And I think it's less that, it's more what you just said, which
There
is
you go.
it's a signaling
Will's
tool,
on board.
and it's a signaling tool that we're not behind the curve, but I don't think it's based upon some data that shows that actually economic conditions are deteriorating faster than the market expects.
Agreed, actually, with Will. Totally agree.
Yeah, I mean, I think sort of spoiler alert, the Fed doesn't know any more than we do.
That too.
Collectively,
Totally agree on that.
markets, the Fed doesn't. They may have 250 PhDs working on these things, which is what I think the latest count was. But the reality is that they've got great tools, they've got great nowcasting factors, but they're in the public domain, and they're telling us that there's not a great deal wrong with the economy. So we've got to take that at face value. Are they sensitive to problems in the regional banks? Maybe. But again, I mean, their track record of being preeminent here is not great. I mean, let's just recall what Bernanke was saying in 2008, ahead of the crisis, about there being no problems in the U.S. housing or mortgage markets. I mean, the Fed, supposedly has his fingers on the pulse, but somehow, missed that.
I love this this question. Actually, maybe Will, you can also add some good color commentary on this. Can unemployment be a metric used long term by the Fed if machine learning / AI job replacement accelerates? That's an interesting one to talk through.
Yeah, I think that's the same point about immigration. I mean, if you get a lot of refugees or whatever coming in into the economy, is unemployment such a great metric? And I think these are extremely valid points. They're obviously going to be a false metric going forward. But I think there's so many things which are false about looking at these benchmarks. I mean,
Exactly.
Again, look at inflation numbers. My personal inflation rate sure ain't 2%. I can assure you, and I bet you, gentlemen, your personal inflation rate is significantly higher than 2%. So who on earth is in this camp?
Yeah, it's the same. We could expand it, to a lot of these statistics. The jobs numbers and how they measure specific unemployment claims, and all of these things are sort of highly engineered. Let's just say.
Yeah. I noticed there was somebody put a question up about why is the easing cycle, or why is the cycle 5 to 6 years or whatever it is. I think that's an interesting point to note. And what I would say is that if you look at the business cycle historically, the textbooks tell you it's sort of circa 9 to 10 years. And the reason for that is actually that's the replacement cycle of fixed capital.
Yeah.
And that that's why, because economies are driven by capital spending. The replacement cycle in capital is 9 to 10 years. That gives us that business cycle. Or if you want to look at inventory, it's the replacement of inventory, which is a shorter, maybe 2-3 year cycle on top of that. But why is it a 5 to 6 year cycle? Because that's the average maturity of debt. And so what's driving financial markets is the debt replacement cycle, the debt refinancing cycle.
100.
And that's the important thing to remember.
Especially now, as indebted as everybody is around the world. Debt to GDP around the world averaging 300%. This is definitely a real thing he's talking about.
If I'm hearing you right, the melt-up continues because of liquidity.
Yeah.
There is no risk of spreads widening. A momentary glimpse of it with the reverse curve.
They're rigging the markets. The Fed and the Treasury are rigging the markets. And now with rates coming down, we're going to see monetary expansion. We're going to see liquidity continue. There's lots of debts to refinance. There's a 5 to 6 year cycle because of the debt refinance schedule. It's going to become even clearer and cleaner, probably lining up with these liquidity lines. But you can go all the way back to the fucking 70s and see how accurate his model is. This is what's happening.
Trade playing out August 3rd, August 5th, but for the most part, that's come and gone. Is there anything that could throw the thesis off? Meaning, could you have a situation where liquidity is rising, but asset prices are
especially
flat,
near the end
down,
of the cycle.
down big? I mean, we've all seen the same stats typically 3 months after the Fed starts to cut rates. Markets, more often than not, tend to go down.
Michael is still trying to find the dark scenario. He's still working hard. He's like, there's got to be a depression in here somewhere.
Yeah, I think it's a very good point. I mean, the way that we see things is very simply, there are two moving parts in markets. One is the flow of liquidity, and the second is the deployment of that liquidity into risk assets. And you can still get an increasing inflow of liquidity, but if investors decide at the margin they're going to allocate a lot more to safe assets and start shunning risk assets, then you've got a problem if that marginal allocation drops.
Safe assets being bonds, especially long-term dated bonds. But you got to have a government that has sustainable debt creation and that isn't going to implode, especially if they're the world reserve currency. So again, we'll see a move like that, but we have to know that America is sustainable and still going to be the leader of the world in 10, 20 years.
Now, what you tend to find is that marginal allocation is influenced by a number of things. I mean, in the very short term, political risk can can affect things.
Elections, all kinds of
The
shit.
most important tends to be things like the tempo of the economy. So if the economy hits recession, then risk exposure, risk appetite will actually dive significantly.
Yep.
So that's one factor to watch for sure. So we're sanguine about the economy. We could, of course, be wrong. But that would be a factor that would change things importantly. The other thing to say is that, markets rotate, and we've got to understand that rotation. And, I've been saying for, a couple of months now, look, this bull market began in October of 22. It's already getting quite old by bull market standards. And you've got to start expecting that gains are going to be less easy to get from here.
When he says this to guys, think about the 4 to 5 year time frame that he's talking about. So he's like, this bull market started in 2022, mid 2022. So when he's saying that the bull market can actually last until 2026. So I just want to make sure that you're understanding the context of what he's talking about.
You've got to think about rotation towards
You do.
later cycle areas of the market. Maybe if yield curves are steepening as we think, you've got to start thinking about, big financial stocks, JPM or this sort of thing. Maybe they could benefit. You've got to start thinking about commodity plays if we're correct about commodity prices picking up. Maybe you think about gold producers.
I don't actually think they're right about commodity prices going up, because I don't think China is as strong as Michael Howell does, and China is the creator and the mover of commodities and prices, right? They're directly, because of the fact that they have the largest manufacturing base in the world. I mean, it's starting to drift away from China. It's going to other parts of Southeast Asia, South America, Central America. It's going to be drifting India. It's going to be moving everywhere else. But the sheer demand that when China has the ability to be able to, or at least historically had the ability to be able to pump markets with a bunch of liquidity and really drive commodity prices, I think they're losing that ability now. And I think China is seeing they're at the start of a depression, in my opinion. And since they're at the start of a depression, they're exporting deflation to the rest of the world. This is the area where I differ from Michael Howell, so I want to speak to it. So I actually think that they're already deteriorating, but I think that that's less impactful to the West and Southeast Asia and India and South America and Central America, because, well, I shouldn't say that. Parts of the West, like Germany, will be impacted because they're heavily dependent upon China. But other parts that aren't, and we just buy their shit, they're going to be less dependent upon what's happening right now. And they, if anything, can be benefactors of China's downfall. This is a huge difference I have between Michael Howell. He was much more optimistic about China. He thought liquidity was going to come back a lot quicker in China. None of those things happened. And that was an area where I differed in thought process, and I was right versus him. Now, I'm not pretending to be smarter than Michael Howell, but I do believe on the subject of China that I have a better lens into what the reality is within that area, which is why I got to make one of these Chinese videos here soon. But to keep that in context. Keep in context that he thinks commodities are going to go up, like Lynn Alden and a bunch of other really, really smart people. And I disagree with them. I do believe we can have some increase in inflation, but I don't think we're going to see the commodity super cycle that all these people are expecting. I do believe risk assets still go up. I do believe that the United States is still the cleanest shirt in the dirty laundry. But Michael Howell is going to talk about how he believes that maybe other markets are good at investing in. And again, that's a risk-on approach. I do agree with a lot of that. But we just have very different lenses on China's strength and what's happening in regard to that with global liquidity in the world.
These type of factors are worth considering. Tech may still be okay because of the trend growth, but it's really the early cycle things that are maybe a bit spent now. So I would think about that rotation. The other thing to say is you may be able to start thinking about international. So if the dollar is starting to weaken a bit, then maybe it's a time to start thinking about Europe or thinking about Asia again. Japan, I think, is a proxy for China. And I think it's a better way to invest in Asia than directly in China. So if the Chinese economy starts to pick up, Japan should be a beneficiary, but then so should the rest of the region. And emerging markets generally do well when the dollar is softening and the Chinese economy is speeding up. So we've got a little bit of the first, but let's wait for the second.
Will, any parting thoughts as we start to wrap up here?
No, I think this has been a great session. Really good. A lot of great questions. Michael, thank you very much for all of your commentary. Super interesting time. Look, again, this is, we don't often get to be the front row seat for periods like this, but going in from this
never
sort of situation where we've been the last few years.
Never.
And now sort of transitioning to that easing cycle, I think the question is clearly, where are we headed ultimately? Where's the terminal rate, if you will? And it's certainly easy to see now a scenario where we're talking 100 basis points, obviously including the 50 that just happened by year end, and that takes us into a very different type of environment. But I think now the question that everybody looks towards is, where does this easing cycle bottom out? And I'm sure that will be discussed very heavily by everybody in the market over the next few months.
Sure, yeah. Markets never stand still.
Mike, for those who want to track more of your thoughts and more of your work, where would you point them to?
Probably the easiest way is Substack.
Yeah, Substack, which I'm already subscribed to, and then also to read his book, Capital Wars. That helps him too. Sela said, but I don't think 30-year mortgages should be at 33%. It just creates housing price surges. I disagree with that, and they will be at 3%. They'll be at 3% by next summer. So early summer, late, like again, the 4%, we're talking about, we've already done 50. The 50 will get us into the upper fives. We're going to do another 100. Between now, potentially, and the end of the year. If we do that, that will get us down to the upper fours. And I think by late spring, we will maybe even crack into the threes. Late spring, early summer, we could see the upper threes, and that won't be a bad thing. What we need is increased inventories. What we need is to stop illegal immigration, where we're bringing immigrants into cities like Springfield and increasing the population by 30%, and making it to where the people that live there are becoming homeless because they can't afford the rents anymore if they don't own the properties. They're getting kicked out, and then everything goes up in value, and then people are selling homes, and the ones that can, and they're leaving because they can get an outrageous amount of money for it because government programs are paying for it. So if we keep importing illegal immigrants, you're going to see housing prices go up like crazy. If we stop that flow and start exporting at least the bad ones, at the very least, maybe keep some of the others for the increase in manufacturing that we might be expecting in the years ahead, then we'll see existing homes prices come down as the market opens up, because you got to remember, over 80%, 85% of home sales traditionally are existing homes, but that market has been completely frozen because nobody wants to sell their existing home and build their dream home because the interest rates on it were outrageous. Well, that tide is going to turn heading into spring, the traditionally strong time in the real estate market across the United States. Especially in upper north areas that, normally over the winter, they just don't sell houses. People don't want to move. So I think you're going to see the housing market explode, and you're going to see eventually here that will lead to new home builders going up a lot again in another secondary surge, as they're going to see massive demand that's going to be coming because of lower interest rates. And again, we'll see it'll be probably a hiccup where existing homes come on, new homes don't get the margins they were before. You see those guys kind of roll over, the new home builders, and maybe have a dip, and then eventually they start to surge up again as the housing market really ignites. So that's the kind of stuff I see happening like over the next year. We could get kind of a really, like, people getting very excited about things, the economy just kind of coming back to life, even while we see more pain and suffering in countries like China. We'll see other parts of Asia, other parts of India, or I should say India, and other parts of Central and South America that will become richer, and that will have businesses flooding into them. Especially if Trump gets elected into the United States, we could see a lot of manufacturing coming over here too, benefiting us even more. So we could be literally on the cusp of greatness, guys. You have to factor in the fact that we have autonomy, AI, robotics, all these things moving at blistering paces. Elon was talking about Grok 3 being the most intelligent AI on Earth here in the not too distant future because it's got 10 to 20x the compute that it's training off of. I already use Grok every day. I can't imagine what a 20x compute Grok 3 looks like as the smartest AI on Earth. And then they'll license that AI to their robot Optimus that they're going to start deploying out and selling to people next fucking year. I'm going to order like 5 of those out of the gate. I need at least 5 robots. Maybe I'll order 10. I don't even know. I need at least 5. But in the not too distant future, guys, there's going to be so much changing that if we can just get our economic house somewhat in order, and then continue to be pro-growth, low-tax environment, we could be looking at one of the greatest times in history for wealth creation. Now, a lot of things need to happen for that to line up, and you guys need to stay abreast of that, and we need to keep working as a community to figure it all out. But I strongly believe that we're headed towards the potential of one of the greatest economic times in history. If we don't fuck it up, if we don't nuke ourselves, if we don't die from robots, taking us out, like Will Smith taught us years ago, we could be on the precipice of something great, and that's the future I want to work towards. That's the future I want to help fund. That's the future I want to vote for, and I hope you guys do too. Anyway, I hope you enjoyed the video. Let me look real quickly and just get caught up on chat. So Lord Drake says, amazing display of intelligence. Thanks, learning by day. Yeah, Michael Howell's brilliant, dude. JD, I could see 3.5 to 4%. Yeah, we'll be in the threes. By summer, we'll be in the threes. And I think that's really going to be great for the economy. Because, again, you got to realize all these commercial real estate owners, too, have been getting crushed because they're paying high interest on debts where they don't have any tenants. There's a lot of problems there. I think all of that is addressable for now. But they need low interest rates, just like the government needs low interest rates in order to be able to continue to sustain itself and be seen as the world reserve currency. JD also says, I think we should kick out illegals that pay no taxes. There are a lot of them. If you've been paying taxes for years, contributing to society, you should probably get to stay. That's kind of the same approach. I'm not as heavy-handed as Trump is, and I think he's going to actually, if we get as much manufacturing as we're thinking about getting, we'll have to do something where we start granting citizenship. He just wants it to be under his watch. He should actually vocalize that now, that as long as you don't illegally vote in an election, and you're not committing crimes, and we get the border closed, we'll look at the remaining immigrants and determine whether or not they get to stay or whether or not they go, depending upon job availability and a number of other factors on how hard they've worked while they've been here. I think that what will end up happening won't necessarily be a mass exportation, but we have levers we can do without forcing people out. We have levers in order to be able to ensure that they either leave and that we could give them a pathway to leaving if that's what we need to do from a country standpoint, fiscally, economically, or we get them to stay. And I think the kind of incentives you have where you have overtime, like that doesn't get taxed, and things where you encourage people to work hard. Immigrants, guys, are the foundation of this country. I think we need to have strong legal immigration paths, and maybe some amnesty should be granted towards people that are here. But we got to stop the flow of traffic. It's not sustainable. It'll destroy our country. And then we need to get rid of all the bad guys. You commit crimes. You murder somebody, you're dead. You violently hurt somebody, put them in a coma, you're dead. We need to really with illegal immigrants that are in this country, we need to make it to where you're either a good guy and work hard and you get to stay if we have the jobs for you, or you get the fuck out. You get the fuck out. Because you're a bad guy and you're either and we don't want to have them in our prisons. So if they're committing violent crimes and hurting people, they need to be taken out, or they need to be deported immediately. And we need to do those things in order to be a viable country. But we need immigrants. We just need legal immigration. We need to get people here that have a legitimate reason, like fear of life, death, in their own countries. We need to help those people out, or they fit jobs that we need to suit within the United States, which is kind of something that the Kamala Harris and Biden regime have been doing illegally with executive orders for the 850,000 people they've shipped into this country in their 4 years term, and plus 1 million that they've got on the sidelines ready to come over too. But we need to do this the right way. We need to do it through Congress. We don't need to do it illegally through executive actions and trying to expand the power of the executive branch. That's bullshit. But let me just get through the rest of the comments here. Well, somebody's at the front doorbell. Alpha Turtle says, as someone who is raised and a blind faith liberal, I love your political commentary. You know what, man? I was raised a staunch conservative Baptist Republican, and then I drifted towards liberalism, and then I started to drift back definitely towards economic conservatism. That's a strong thing. And then, but also, I believe that religion, that there are moral codes that are, at least in Christianity, that I think are beneficial to the world. And so I like those views. I don't think you should. I don't think you should push conversion or death. Like radical Islam, I'm very much against, because I think the views of it. I think covering up women, making them into sexual objects, making them to objects that can be exploited and abused. I think all of that is fucking disgusting. It doesn't make me racist to say that, because a religion isn't a fucking race. But I do believe that Christianity, out of all of them, and again, it's been used for evil things too over time. You look at the Crusades, just religion can be used as a tool for really horrific things. But if you look at the modern day versions of it, it's really quite docile, and the moral code that goes along with it, I think, is a positive for humanity. And I do believe that America needs to have a positive moral code, whether you're religious or not. We can't just say that, words get you 2 years in prison like the UK is doing, but murdering people gets you about the same. That's not how America can be. It's just not. We won't survive if we're that way. Mr. Cold, one, I gotta hear the reasoning behind needing 5 bots. Why not? Elon thinks there'll be 3 bots for every person on Earth. I've got a lot of family members that I would give a number of them to, and I could probably put them to work. Plus, I'm going to have a fleet of autonomous vehicles that I'm going to be making a bunch of money off of. I've got 2 already where FSD is locked in. I'd like to have at least a 3rd or a 4th one. I like additional revenue streams. I'm getting stuff from social media right now. I'm a great investor. And then I can make revenue streams from things that are working for me too, which I like, right? Amen, brother, from Andrew. Thank you, sir. Let me see here if there's anything else, guys. Might call it here soon. Got a lot to do. Got to get the Discord up. Want to do a political video later today. Need to go on a walk with my wife, spend some time with my family. And then I got to get ready. Like I said, guys, tomorrow I'll try and do the Bitcoin miner one, talking about crypto too. It's probably not going to be super refined, not much better than it was last week, maybe a little. And then on Monday I'll be doing the morning stream before the markets open. But after that I'll be traveling for the rest of the day, so I won't probably do anything until maybe later that night, or most likely the Tuesday morning stream. So I'll have a little bit of time away. Silas says, this isn't 100 years ago. The country is populated. It should be mostly built by our descendants. True, but you still want a path to legal immigration to suit jobs that your country needs filled, and you want a path to legal immigration because of the fact that our country, we don't have a high enough fertility and birth rate in our country. We need to fix that too. We can do that through government incentives like the child tax credit and others that make it economically beneficial to have children. And I think people like Elon Musk are helping with that messaging too. But you got to remember, the liberals were pushing for a long time that having children was bad. It was killing the earth and all this bullshit. Just like cow farts are killing the fucking earth. Mark LeBlanc, we need engineers and doctors instead. We're getting criminals. No wonder politicians support them. They can relate. Yeah, it's a mess. We need the best and brightest of the world to still want to come here, and we need to definitely let them in. But for humanitarian reasons, especially where there's genocide occurring, we should be working to help people get in here too. People that would be grateful for not being murdered by whatever's going on in their existing governments, and people that are taught to be respectful and love this country, like I was when I was a kid, when I had to salute the flag and recite the Pledge of Allegiance every day as a child, something that we've drifted away from in academia, something where we don't respect our country anymore. And we don't need to blindly follow our country. We can realize that we're faulted. We can realize that we have problems. We can realize that we start wars we shouldn't. We can realize that we're flawed because human nature is flawed. But we should work to better our country and to respect it. And we can still speak against it. That is one of the beautiful things about free speech. But we shouldn't be censoring speech. We shouldn't be drifting away from codes of morality that have made this country great. True refugees are their own thing and should be given sanctuary, but if the danger dissipates, the only ones that can stay are after positive review. Agreed. I won't argue with you there. If you're a bad person committing crimes in this country, and you came here through legal immigration, then you should go away. And again, I do believe that a path towards amnesty, or a path towards citizenship for illegal immigrants in the country might have to happen, because if we do the things that Trump was talking about doing, if he wins, then we'll probably need to keep some. That's just the way it is, or start doing legal immigration in a strong way. while we're getting rid of the rest. But I don't know. Turn the tide on the Democrats. Make it to where some of them get to stay, and they're loyal to Republicans. Because again, especially with a lot of them being Hispanic, a lot of them. I mean, there's other parts. There's definitely a lot of people coming from Africa and coming from China, coming from other parts of the world nowadays too. But a lot of these guys have a similar moral code from a religious standpoint to the people that are already here in the United States. They have a similar thought process. They have conservative values. I mean, Hispanics in Florida, they vote like overwhelmingly Republican, right? So there's definitely some of that where we need to lean into that maybe and turn that against them. And I say against them. I was them like a year ago. Dr. Gonzo, in Canada, the immigration is insane. It's largely for wage suppression here. That's what they did here. That's what the Democrats did here, too. They wanted to suppress wages. But by doing that, they're alienating the black vote, which is why blacks are twice as likely to vote for Donald Trump this election as they were the last. And that one was twice as likely to vote for Donald Trump versus what happened with Hillary Clinton in 2016. So I think you're alienating the bottom cohort of society, all the poor, whether they're black or whatever color of skin they have. A lot of them are black, though. So you're making it to where you told them that you were going to do all these things for them and you were going to get them reparations and all this other bullshit that they said in 2020. They've done jack shit for that. And now black people are waking up and going, wait a second, is this the same party that created the KKK? Is this the same party that said that they would keep these N-word people voting for them for 200 years? Oh yeah, it is. That is the Democratic Party. So fuck them. Fuck them. Let's work with the people that actually want to help us. And so I think that tide is happening right now. And as long as we can ensure fair elections, or at least reasonably fair elections, where illegal immigrants aren't able to vote, we're going to win. And that's what they're afraid of. Manny247, if Kamala gets in Thailand, we'll lose the Ladyboys. I don't know what that's about. But Dr. Gonzo and BNY Mellon being able to custody BTC. Always enjoy your BTC commentary. Look forward to your videos ahead. That's such a huge thing for Bitcoin, guys, and it's a huge tide shifting turn that we're seeing, where we're letting a bank actually custody Bitcoin for the first time in history. JD, you can't be racist against a white person is the most ridiculous thing. It's bullshit. I'm sorry, guys. You can be totally racist towards a white person. I grew up in the dirty South, okay? I lived in Alabama. I went to a school that was over 93% black, and then like the other 5 to 7% were of other ethnicities, and then there was me and like a couple of white dudes, okay? So if you don't think that you can be racist towards white people, I can tell you my poor white ass had a lot of racism performed against him. Did it make me bitter and hate black people? No. You know what? When I moved up north and I saw black people around here that were being mistreated, if anything, I related to them better because I had been in their situation. So if anything, it causes me to love minorities more. And again, you can be racist against white people. We see it every day. That's what DEI is, okay? And here's the thing. I don't have any white guilt. You know why? I grew up as a poor white motherfucker who didn't have anything. And the color of my skin didn't seem to help worth a shit. And it sure as fuck wouldn't help now because of DEI. So, fuck all that noise. Fuck all that. That's just lazy fucking people. Lazy, stupid fucking people. Some of them white guys for Harris who have been indoctrinated for years to have a view that they're the bad guys. But what they don't think about is they don't think about the fact that America, the white people in America ended fucking slavery. Okay? We didn't create it, but we ended it. And we were an example for the rest of the fucking world. Did we take over a country where Indians didn't believe in owning land and impose our values on those people? Did we fuck those people in the process by giving them reservations and giving them no real hope for success in life? We didn't incorporate them into our society. We just said, hey, here's your little plot of fucking land. And then we gave them government subsidies to try and help to a degree. But we didn't do anything good for them. Yeah, that fucking happened. Do we make mistakes? Yes, we do. We're still the greatest country in the fucking world. Our values do matter. And we're going to be the world reserve currency for a long time. And I digress. This is a little bit far beyond what Michael Howell was talking about. So I'm probably going to end it here, guys. But I love you guys. Don't hate yourself because you're white. And don't hate other people at all. Don't judge people by the color of their fucking skin. It's probably the first thing you need to understand. Because it doesn't matter. It doesn't matter. Like Martin Luther King said a long time ago, I dream of a day where people will judge me by my merit, you know, and I'm obviously paraphrasing quite a bit, but that won't judge me by the color of my skin and will judge me by what I do, as a human being, and have respect for people like that don't hate white people because of whatever preconceived notion, and instead look and go, this is just about as fair as the way I was treated when I was a kid, and I don't like it. And we should all treat each other with respect, irregardless of what we look like, irregardless of the place that we were born. We should try and treat each other with respect and say, hey, who is this person? What is their moral code? What are their values? I can align with that. That's the way we should look at people. Fuck the whole skin color, sexual orientation, all the bullshit that people try and use to separate us. Fuck that. Anyway, love you guys. Hope you enjoyed the stream. And let's make a lot of money over the next year. And peace out, guys. I'll see you a little bit later, okay?